Ready to pass the CPA exam faster? Visit cpapass.ai. Today, the presumed fraud risks that you cannot rebut on AUD. On the AUD section of the CPA exam, specifically under Area 2, candidates frequently fall into a dangerous trap. The examiner will present a scenario where a client has immaculate internal controls, a stellar reputation, and highly sophisticated security systems. The question will then ask if the auditor can bypass assessing fraud risks altogether. If you answer yes, you will lose automatic points. Professional standards establish that certain fraud risks are so fundamental that they must always be evaluated. The core distinction you must master is that while some presumed fraud risks can be rebutted with extensive documentation, others are absolute and can never be bypassed. Understanding this boundary is critical for planning your audit response on test day. Under auditing standards AS 2401 and AUC 240, the auditor must start with the presumption that revenue recognition is a significant fraud risk. Why is this the default rule? Historically, revenue is the #1 area for financial statement manipulation, often involving fictitious sales or cutoff errors designed to overstate performance. However, the key exam takeaway is that this presumption is rebuttable if the auditor documents specific clear reasons, such as an extremely simple single-stream cash transaction model with zero complexity. They can overcome this presumption. But remember, you cannot just ignore it. You must explicitly document the justification for rebutting this risk, or you fail to comply with professional standards. Now let's look at the risk that can never be rebutted: management override of controls. Professional standards dictate that management override must be treated as a significant fraud risk on every single audit engagement. There are absolutely no exceptions to this rule, regardless of management's perceived honesty or how strong the client's internal control environment appears to be. Because this risk is non-rebuttable, the auditor is required to perform specific responses. These mandatory procedures include testing the appropriateness of journal entries, reviewing accounting estimates for potential management bias, and evaluating the business rationale of significant unusual transactions. On the exam, if a scenario suggests skipping these procedures because controls are strong, it is a trap. Let's compare these two critical risks side by side to solidify your understanding. Revenue recognition is a presumed fraud risk focusing on transaction level overstatement, but it is rebuttable if you document a valid justification. In contrast, management override is a presumed fraud risk focusing on management bypassing established controls, and it is completely non-rebuttable. Despite this difference, they share a vital commonality. Both are classified as significant risks. This means the auditor cannot rely solely on internal controls to mitigate them. You must perform direct substantive procedures for both. Memorizing this distinction and their shared requirement for substantive testing will help you navigate complex simulation questions on cpapass.ai. To wrap up, let's review the critical exam traps. First, do not confuse engagement risk with audit risk. Audit risk is the narrow risk of issuing an incorrect opinion, whereas engagement risk is the broader exposure to firm reputational damage or lawsuits from client association. Second, never assume that strong internal controls allow you to skip substantive testing for significant risks. Substantive procedures are always required. Finally, remember the golden rule: revenue recognition is a presumed risk that can be rebutted with proper documentation, while management override can never be rebutted. Keep these distinctions clear, practice your active recall on cpapass.ai, and you will easily secure these points on your AUD exam.